The gold standard is a monetary system in which a country's currency is directly linked to a fixed quantity of gold. Under this system, paper money is not valuable by itself. Instead, it represents a claim on a specific amount of physical gold stored in government or central bank reserves. The gold standard was created to solve one fundamental problem of early economies: trust. Before the gold standard, money systems were inconsistent and often unreliable. Governments frequently debased coins by reducing precious metal content, leading to inflation and loss of confidence. Trade across borders was risky because currencies fluctuated in value and were not universally accepted. Gold, however, was trusted everywhere. It was scarce, durable, divisible, and universally valued. These qualities made it the natural anchor for a stable monetary system. The idea behind the gold standard was simple. If money could always be exchanged for gold at a fixed rate, people would trust the currency. Governments would be forced to maintain discipline because they could not print unlimited money without possessing enough gold to back it. This created a self-limiting system that restricted inflation and promoted long-term price stability. Early forms of the gold standard existed long before modern banking. Ancient civilizations used gold coins with fixed weights and purity. However, the formal gold standard, where governments legally guaranteed convertibility between paper currency and gold, began developing in the 18th and 19th centuries alongside modern banking systems. Britain was the first major country to adopt a full gold standard. By the early 1800s, the British pound was defined by a fixed amount of gold. The Bank of England maintained reserves and promised conversion on demand. Because Britain dominated global trade and finance, other nations gradually followed. By the late 19th century, most major economies, including the United States, Germany, France, and Japan, had adopted the gold standard. The gold standard was designed to control inflation, stabilize exchange rates, promote international trade, prevent reckless government spending, build long-term economic trust. Under this system, currencies were stable because their value was fixed relative to gold and, therefore, to each other. International trade expanded rapidly because merchants no longer faced unpredictable currency risk. However, this stability came at a cost. Economic growth was limited by gold supply. Governments had little flexibility during crises. The gold standard worked best during peaceful periods but struggled under extreme pressure. This chapter establishes the foundation. The gold standard was not accidental. It was a deliberate attempt to create a disciplined, trustworthy, and globally accepted monetary system. The period between 1870 and 1914 is known as the Classical Gold Standard era, often considered the most successful phase of gold-based money. During this time, nearly all major economies operated under a shared gold standard, creating the first truly global monetary system. Under the classical system, each country defined its currency in terms of gold exchange rates were fixed. Gold flowed freely between nations. Central banks maintained convertibility. This system worked because governments respected strict monetary discipline. If a country ran a trade deficit, gold flowed out to pay for imports. This reduced its money supply, lowered prices, and made exports more competitive. Surplus countries experienced the opposite effect. This automatic adjustment mechanism balanced global trade without political intervention. The classical gold standard delivered remarkable results: long-term price stability, low inflation, predictable exchange rates, rapid growth in international trade, expansion of global investment. London emerged as the world's financial center. British banks financed railways, factories, and infrastructure projects across the globe. Capital flowed freely from Europe to the Americas, Asia, and Africa. Gold provided the confidence needed for massive cross-border investment. The United States joined the gold standard formally in 1900. Its growing industrial power and increasing gold reserves strengthened the global system. Germany and France also accumulated significant gold, reinforcing their currencies. By the early 20th century, gold had become the backbone of global finance. However, the system had hidden weaknesses. It required political stability. It depended on cooperation between nations. It restricted governments during economic downturns. It could not easily finance large-scale wars. The gold standard functioned well during peace, but was extremely fragile during crisis. Governments could not print money freely to respond to emergencies. This rigidity would soon be tested on an unprecedented scale. As Europe moved closer to war, nations quietly began preparing to suspend gold convertibility. Military spending, debt accumulation, and political tension threatened the foundations of the system. The gold standard was about to face its greatest challenge. The outbreak of World War I in 1914 marked the first major collapse of the global gold standard. Before the war, the gold standard functioned because governments maintained fiscal discipline and avoided excessive spending. War changed everything. Military conflict on a global scale required unprecedented financial resources, far beyond what gold reserves could support. As soon as war began, major powers such as Britain, Germany, France, and Russia suspended gold convertibility. Governments needed to finance armies, weapons, transportation, and supplies immediately. Maintaining the gold standard would have forced them to raise taxes sharply or cut spending both politically impossible during wartime. Instead, they chose to print money and issue debt. This decision fundamentally broke the rules of the gold standard. Paper money was no longer backed by gold, and currencies began to lose value. Inflation increased as money supply expanded rapidly. Countries borrowed heavily, both domestically and internationally, to fund the war effort. Gold reserves were hoarded rather than circulated, as governments feared losing financial control. The war also disrupted international trade. Shipping routes were blocked, financial markets closed, and cross-border payments became difficult. Gold flows stopped functioning as an automatic balancing mechanism. Instead of moving freely between countries, gold was locked inside national vaults. When the war ended in 1918, Europe was financially exhausted. Governments were deeply indebted, economies were damaged, and currencies were unstable. Many countries attempted to return to the gold standard, believing it would restore pre-war stability. However, the conditions that made the gold standard successful no longer existed. Germany faced extreme financial pressure due to war reparations imposed by the Treaty of Versailles. To meet obligations, the German government printed massive amounts of money, leading to hyperinflation in the early 1920s. The value of the German mark collapsed completely, destroying savings and public trust. Britain attempted to return to the gold standard in 1925 at its pre-war exchange rate. This decision overvalued the pound, making British exports expensive and damaging domestic industry. Unemployment rose, wages fell, and economic instability increased. Other countries experienced similar difficulties. World War I proved that the gold standard could not survive large-scale global conflict. It required peace, cooperation, and fiscal discipline conditions incompatible with modern warfare. The first collapse of the gold standard marked the beginning of a long period of monetary instability that would dominate the first half of the 20th century. The period between World War I and World War II, known as the interwar years, was marked by economic confusion and failed attempts to restore the gold standard. Governments believed that returning to gold-backed money would bring stability, but the global economy had changed too much. Many countries reintroduced gold convertibility in the 1920s, but they did so under different rules. Instead of holding physical gold, some countries held reserves in foreign currencies like the British pound or US dollar, which were themselves linked to gold. This created a fragile system known as the gold exchange standard. This new structure increased global interdependence, but also multiplied risk. If one major currency collapsed, it would destabilize others. The system depended heavily on Britain and the United States maintaining strong gold reserves and financial discipline. Economic imbalances grew throughout the 1920s. The United States accumulated large gold reserves due to trade surpluses, while European nations struggled with debt and weak currencies. To protect gold reserves, central banks raised interest rates, reducing credit and slowing economic growth. The situation worsened dramatically with the Great Depression beginning in 1929. Stock markets collapsed, banks failed, businesses closed, and unemployment soared worldwide. As economies contracted, governments faced rising pressure to stimulate growth. However, the gold standard restricted their ability to expand money supply or lower interest rates. Countries that abandoned the gold standard earlier, such as Britain in 1931, recovered faster. Those that remained tied to gold experienced deeper and longer depressions. By the mid-1930s, most nations had fully abandoned gold convertibility. The interwar experience revealed critical weaknesses of the gold standard. It restricted economic recovery during crisis. It amplified deflation and unemployment. It required international coordination that did not exist. It could not adapt to modern economic shocks. The failure to restore a stable gold system during the interwar period set the stage for a new approach to global finance. Governments realized that strict gold backing was incompatible with modern economic management. The world was moving toward a new system, one that combined gold with greater monetary flexibility. This transition would occur after World War II, when global leaders attempted to design a monetary order that avoided the mistakes of both the gold standard and the interwar chaos. World War II created economic destruction on a scale even greater than the First World War. Entire industrial centers were destroyed, national debts exploded, and global trade collapsed. By the early 1940s, it was clear that the pre-war monetary system had failed completely. Leaders understood that once the war ended, the world would need a new financial framework, one that provided stability without the rigid constraints of the old gold standard. In 1944, representatives from 44 Allied nations met in Bretton Woods, New Hampshire, to design a new global monetary system. Their objective was to prevent future economic chaos, avoid competitive currency devaluations, and promote international trade and reconstruction. The result was the Bretton Woods system, a compromise between gold-backed money and modern monetary flexibility. Under Bretton Woods, the U.S. dollar became the central reserve currency. The dollar was convertible into gold at $35 per ounce. Other currencies were pegged to the U.S. dollar. Exchange rates were fixed but adjustable. Governments could manage economies with limited flexibility. The United States emerged from World War II with the strongest economy and the largest gold reserves in the world, holding nearly 70% of global gold. This made the dollar the natural anchor for the system. Gold no longer backed every currency directly. Instead, it backed the dollar, which then backed all other currencies. Two major institutions were also created: International Monetary Fund, IMF, to manage exchange rates and provide financial assistance; World Bank to support reconstruction and long-term development. The Bretton Woods system restored global trade, stabilized currencies, and fueled rapid economic growth during the post-war period. It avoided many weaknesses of the classical gold standard while preserving gold's role as a foundation of trust. However, the system depended heavily on U.S. economic discipline. As long as the United States maintained strong gold reserves and limited dollar issuance, the system remained stable. Over time, this balance became increasingly difficult to maintain. By the 1960s, cracks began appearing in the Bretton Woods system. Global trade expanded rapidly, requiring more dollars to circulate internationally. At the same time, the United States faced rising expenses from social programs and the Vietnam War. To finance these costs, the U.S. issued more dollars than its gold reserves could support. Foreign governments accumulated large dollar reserves and began questioning whether the United States could honor its promise to convert dollars into gold. Some countries, notably France, demanded gold in exchange for their dollars. This placed increasing pressure on U.S. gold reserves. This situation highlighted a fundamental flaw in Bretton Woods. The global economy needed more dollars for trade, but issuing more dollars weakened confidence in gold convertibility. This contradiction became known as the Triffin Dilemma. By 1971, the U.S. gold reserve had fallen significantly, while foreign dollar holdings continued to rise. Maintaining the $35 per ounce gold price was no longer possible. On August 15, 1971, President Richard Nixon announced that the United States would suspend the dollar's convertibility into gold. This decision became known as the Nixon Shock. The immediate effects were dramatic. The Bretton Woods system collapsed. Fixed exchange rates ended. Currencies began floating freely. Gold prices surged. Inflation increased worldwide. The gold standard was officially dead. For the first time in modern history, the global monetary system operated entirely on fiat money, where currency value was based on government authority rather than physical gold. Although gold no longer backed currencies, it did not lose its importance. Instead, it transitioned into a reserve asset, an inflation hedge. Central banks continued to hold gold as protection against currency instability. The end of Bretton Woods marked the beginning of a new era, one defined by monetary experimentation, rising debt, and expanding central bank power. After the collapse of the Bretton Woods system in 1971, the global economy entered the fiat currency era. Fiat money has no intrinsic value and is not backed by physical commodities such as gold. Instead, its value comes from government authority, legal tender laws, and public confidence. This transition fundamentally changed how money, debt, and economic policy operate. Under fiat systems, governments and central banks gained unprecedented flexibility. They could expand or contract the money supply based on economic conditions. Interest rates became the primary tool for managing inflation, employment, and growth. This allowed rapid responses to recessions, financial crises, and shocks, but also introduced long-term risks. One of the most immediate consequences of abandoning gold was inflation. During the 1970s, many countries experienced high inflation as governments adjusted to the new system. Without gold constraints, money creation increased, often faster than economic output. Oil shocks further intensified inflationary pressures. Central banks evolved into powerful institutions. The U.S. Federal Reserve, European Central Bank, and others gained control over money supply, interest rates, credit availability, financial system stability. Over time, financial markets became more complex. Credit expanded rapidly, government debt increased, and economies became increasingly dependent on borrowing. Fiat money enabled sustained economic growth, but it also encouraged risk-taking and asset bubbles. Despite the shift away from gold-backed money, gold remained relevant. Investors and governments viewed it as a safeguard against inflation, currency devaluation, and political uncertainty. Gold prices rose sharply during periods of instability, reinforcing its role as a store of value. The fiat currency era introduced efficiency and adaptability, but also weakened long-term monetary discipline. The absence of a physical anchor increased reliance on trust in institutions, a trust that would be tested repeatedly in future crises. Although gold no longer defines currencies, it continues to play a significant role in the global financial system. Central banks, governments, and investors hold gold as a strategic asset rather than a monetary foundation. Its importance lies in stability, diversification, and psychological confidence. Central banks hold gold for several reasons: protection against currency crises, diversification away from foreign reserves, hedge against inflation and debt, symbol of financial sovereignty. Since the early 2000s, many countries, particularly emerging economies, have increased their gold reserves. Nations such as China, Russia, and India have actively accumulated gold to reduce dependence on the US dollar. This trend reflects growing concern about geopolitical risk and long-term currency stability. In financial markets, gold serves as a safe haven asset. During economic uncertainty, investors shift from stocks and bonds to gold. Its price often rises during financial crises, high inflation periods, currency devaluations, geopolitical conflicts. Gold also plays a role in modern financial instruments, including exchange-traded funds, ETFs, futures contracts, and derivatives. These products allow investors to gain exposure to gold without holding physical metal, increasing liquidity and market participation. Despite technological advancements and digital currencies, gold retains a unique status. It has no counterparty risk, cannot be printed, and has maintained value across centuries. This enduring trust distinguishes gold from fiat money and even cryptocurrencies. Gold's modern role is not about backing currencies, but about anchoring confidence. It exists outside the financial system while influencing it indirectly. Throughout modern economic history, gold has maintained a strong relationship with inflation, government debt, and financial crises. Even after the end of the gold standard, gold continued to act as a reference point for trust when confidence in paper money weakened. This role became increasingly important as global debt expanded under fiat currency systems. Inflation occurs when the purchasing power of money declines, usually due to an increase in money supply without corresponding economic growth. Under the gold standard, inflation was naturally limited because gold supply grew slowly. In the fiat era, inflation became more common as governments gained the ability to print money freely. During such periods, gold often preserved value while currencies lost purchasing power. Historical examples clearly demonstrate this pattern. During the high inflation period of the 1970s, gold prices rose dramatically as confidence in fiat currencies declined. Investors turned to gold to protect savings from erosion. Similar trends appeared during later inflationary episodes, reinforcing gold's reputation as an inflation hedge. Government debt has also played a central role in gold's modern relevance. As nations accumulated massive public debt, concerns grew about long-term fiscal sustainability. High debt levels increased the risk of currency devaluation, either through inflation or financial repression. Gold, which carries no default risk, became an attractive alternative to government bonds and fiat assets. Financial crises further strengthened gold's importance. During banking collapses, market crashes, and sovereign debt crises, trust in financial institutions weakens. Gold tends to perform well during such periods because it exists outside the credit system. It does not rely on promises, contracts, or political decisions. The 2008 global financial crisis highlighted these dynamics. As banks failed and governments implemented massive bailouts and stimulus programs, gold prices surged. Central banks expanded balance sheets, lowered interest rates, and introduced unconventional monetary policies. These actions stabilized economies in the short term, but raised concerns about long-term inflation and currency debasement. Gold's response to crisis is not always immediate, but over time, it reflects declining confidence in monetary stability. This makes gold less a speculative asset and more a form of financial insurance. The relationship between gold, inflation, and debt demonstrates why gold has survived every monetary system. While currencies change and policies evolve, gold continues to function as a long-term measure of value and trust. The rise of digital money and cryptocurrencies has revived global debate about the future of gold. For the first time in modern history, gold faces competition from assets designed to replicate its key features: scarcity, independence from governments, and protection against currency debasement. This comparison has become central to discussions about the future of money. Cryptocurrencies, particularly Bitcoin, were created in response to weaknesses in fiat systems. Bitcoin's fixed supply, decentralized structure, and resistance to monetary manipulation attracted supporters who viewed it as digital gold. Like gold, Bitcoin is not issued by a central authority and cannot be created at will. Despite these similarities, fundamental differences remain. Gold has a long history as a store of value spanning thousands of years. It has survived wars, empires, and monetary collapses. Cryptocurrencies, by contrast, are relatively new and untested across multiple economic cycles. Their value is highly volatile and dependent on technological infrastructure, regulation, and market sentiment. Gold's physical nature provides advantages that digital assets cannot replicate. It does not rely on electricity, networks, or cybersecurity. It carries no technological risk and remains valuable even during systemic breakdowns. Central banks trust gold precisely because it exists outside digital systems. Digital currencies, however, offer speed, portability, and efficiency. They enable instant global transactions and reduce dependence on traditional banking infrastructure. These features make them attractive for modern economies and cross-border payments. Rather than replacing gold, digital money is more likely to exist alongside it. Gold functions as a long-term reserve asset, while digital currencies serve transactional and speculative purposes. Central banks exploring digital currencies continue to hold gold, signaling that gold's role remains unchanged at the highest levels of financial power. The competition between gold and digital assets highlights a broader truth. Trust remains the foundation of money. Gold derives trust from scarcity and history, while digital currencies derive trust from technology and decentralization. Both address weaknesses in fiat systems, but in different ways. As monetary systems evolve, gold's relevance is not diminishing. It is being redefined within a more complex financial ecosystem. The long history of gold as money offers critical lessons for understanding the future of global finance. Across centuries, monetary systems have repeatedly changed, yet the fundamental challenges remain the same: maintaining trust, controlling inflation, managing debt, and supporting economic growth. Gold's endurance across these transformations reveals why it continues to influence modern monetary thinking. One of the most important lessons from gold history is the balance between discipline and flexibility. The gold standard imposed strict limits on money creation, which protected currencies from inflation, but restricted governments during crises. Fiat systems provide flexibility, but often encourage excessive debt and monetary expansion. Neither system is perfect. The challenge lies in combining stability with adaptability. Another key lesson is that monetary systems fail when trust erodes. Gold-backed systems collapse during wars because governments broke their promises. Fiat systems face pressure when inflation rises or debt becomes unsustainable. In every case, loss of confidence, not technical design, triggers monetary breakdowns. Gold consistently benefits during these moments because it exists beyond political systems. The future of global money will likely be multipolar rather than dominated by a single system. The US dollar remains the world's primary reserve currency, but challenges are increasing. Rising debt, geopolitical tensions, and alternative payment systems are gradually reshaping the global monetary landscape. In response, many countries are diversifying reserves and increasing gold holdings. Central banks are also exploring digital currencies to improve efficiency and control. However, digital innovation does not eliminate fundamental monetary risks. Digital currencies remain forms of fiat money and depend on institutional trust. This ensures gold's continued relevance as a neutral reserve asset. Gold's future role is unlikely to involve a return to a full gold standard. Modern economies are too complex and interconnected to operate under rigid constraints. Instead, gold will continue to function as a reserve asset, a hedge against inflation, a store of value, a symbol of financial independence. History shows that monetary systems evolve, but gold remains constant. It adapts without changing its nature. While currencies rise and fall, gold continues to serve as a benchmark for trust and stability. The story of gold and global currency systems is not about the past alone. It is a guide for the future. Understanding this history allows policymakers, investors, and societies to better navigate the challenges of an uncertain financial world.